All right, let's dive into this one. Jim Simons and Renaissance Technologies.
Yeah.
You guys sent over some really interesting stuff, articles, videos, the whole works. I'm kind of fascinated by this whole idea, this math whiz who went from cracking Soviet codes to building one of the most successful hedge funds like ever, right?
Yeah, yeah. It's pretty amazing. I think it's really interesting how Simon's background, in mathematics and code breaking kind of set the stage for his whole approach to finance, right?
Yeah,
Like
yeah.
he wasn't just looking at traditional market analysis. He was looking for hidden patterns and signals, like almost like he was deciphering like some kind of complex code.
So instead of looking at I don't know, balance sheets and earnings reports, he was looking for these mathematical relationships that everyone else was just missing.
Yeah. And his time at the Institute for Defense Analyses,
Yeah.
back during the Cold War, like really honed those skills. Can you imagine analyzing tons of data, like seemingly random data to uncover these Soviet communications? That's got to be stressful. I bet that experience really instilled in him a certain comfort with risk and uncertainty, which I think is pretty essential for anyone who's going to be successful in the financial markets.
Yeah, it's it was like training for Wall Street without even realizing it. But this one video, Como Jim Simons cria maior máquina de dinero da historia, it mentioned that he actually got bored with academia.
Oh, really?
Yeah, he was leading the math department at Stony Brook University, but he wanted a bigger challenge.
Huh. Yeah, that ambition, that desire for more than just intellectual pursuits, it seems like it was a big driver for Simons. He wanted to apply his math skills to something with tangible results.
Yeah.
And he saw that potential in finance.
So he takes this leap, right, and founds Monometrics in 1978, focusing on currency trading at first. And the video was describing his early strategy as this trend-following algorithm, which compared to what we think of with Renaissance Technologies now, it seems pretty basic.
Oh, yeah, definitely. It was definitely more straightforward. But I mean, even then, you could see the beginnings of his whole data-driven approach. There's actually a story about Simons and his partner literally running from the beach to buy British pounds because their model signaled a move.
Oh, wow.
Yeah. They didn't necessarily understand, British politics or anything, but they trusted the data.
It's that age-old question, right? For traders, do you trust your gut or the numbers? And Simons, it seems, was always a numbers guy.
For sure.
But the articles we read also point out that Monometrics didn't have immediate success. And they even struggled when they tried to apply their models to bond trading.
Yeah, it's important to remember that. It wasn't all smooth sailing. I mean, think about the computing power back then. Late 70s, early 80s, nowhere near what we have today. So even though Simons had this vision for these complex mathematical models, the technology to really implement them, it was still catching up.
So he was almost ahead of his time in a way.
Yeah, I'd say so.
This video, the G. Collier one, it even mentioned that he was getting really frustrated, even considered giving up at one point. It's kind of reassuring in a way, even someone like Jim Simons faced setbacks.
Totally. It humanizes him. He wasn't some infallible trading machine from day one. It took years of trial and error, refining models. Even then, there were bumps along the way.
And this is where he makes this, I think, really pivotal decision. He renames the company Renaissance Technologies, and he starts building this team not from the traditional world of finance, but from fields like, mathematics, physics, and computer science.
That's interesting. He's he understood that to really crack the code of financial markets,
Right.
you needed a different type of expertise.
Yeah.
He wasn't looking for people who knew how to pick stocks. He was looking for people who could see the world through a mathematical lens.
So that unconventional approach and building this culture of collaboration and data-driven decision-making, I think that's set the stage for everything that came after. And then in 1988, they launched the Medallion Fund, which we all know now, right? Initially focusing on commodities and currencies.
Yeah, the legendary Medallion Fund. It wasn't an immediate blockbuster or anything, but they were developing a pretty groundbreaking approach. All these videos kept highlighting how they were dissecting this market data into smaller and smaller segments, searching for these patterns that traditional traders were totally missing. It's can you imagine them dividing the data down to the minute, trying to find these tiny signals?
There's this one video, it's the Breno Sullivan Veros Quant, and they actually mentioned how they were looking at things like sunspots and lunar phases, just to see if there were any patterns there that they could exploit.
Really?
It's pretty wild, but it really shows like their commitment to data analysis.
Yeah.
They were leaving no stone unturned.
Yeah, that's
The-
fascinating. And they were willing to like challenge all this conventional wisdom instead of just relying on like gut feelings or traditional financial indicators. They were building these complex mathematical models, experimenting with all these different variables and just letting the data guide their decisions, which at the time, I mean, that was truly revolutionary.
So they were building these complex models, but were they actually using what we would call like machine learning today?
That's where things get even more interesting, because in 1989, this young mathematician, Berkeley Camp, joins the team. And the Rio Claro Investimentos wealth management video, I think it was, it suggests that this was like the beginning of their quantitative dynasty, because Camp brought this expertise in machine learning, which, back then it was a pretty new field.
So they were incorporating machine learning into their trading strategies way back then.
Yeah, and Camp was like this key figure in developing the algorithms that would go on to drive a lot of Medallion's success. I think it was kind of a turning point, like a shift toward more sophisticated models and like shorter term trading strategies. Because before that, they had been using this longer term trend following approach.
So instead of writing these like long-term trends, they were starting to focus on capturing these smaller, more frequent market movements.
Exactly. They started like dissecting the market data down to 5-minute intervals, looking for these subtle anomalies and correlations that could give them an edge. It's like they were, zooming in on the market's DNA, like finding these patterns that you just couldn't see with the naked eye.
It's pretty incredible that they were able to differentiate themselves from those traditional traders like so early on. They were using all this technology and sophisticated mathematics to gain an advantage in a way that just like had never been done before.
Yeah, and they weren't afraid to challenge conventional wisdom, like the Veros Quant video, I think. It explains how Camp argued for increasing the frequency of trades, believing that even a small statistical advantage, if you combined it with like a high volume of trades, could lead to like significant profits, which was like, a pretty radical concept back then.
It's like playing the odds in a way, right? Like you think about a casino, the house always wins in the long run because of the sheer volume of bets, right? But instead of relying on luck, Renaissance was using math and data to like tilt those odds in their favor.
Exactly. It was a quantitative approach to risk management, like a way of spreading their bets across a huge number of trades, minimizing the impact of any single loss.
But even with all those advancements, they still had their challenges, right? The Giacoio video describes how, like, Simons himself would sometimes interfere with the models.
Oh, really?
Like, yeah, he'd react to news events and, like, make manual adjustments, which actually frustrated Camp.
Huh. That's pretty interesting. I guess it highlights, like, the tension between human intuition and algorithmic trading, right? Like, even Simons, who was the champion of data-driven decisions, I guess even he sometimes struggled to, like, let go of his human instincts.
And then there's that whole thing with James Axe.
Oh, yeah.
Who was like one of the original mathematicians on the team. And he clashed with this whole data-driven approach and like refused to abandon his, I guess, like more traditional trading methods.
Oh, wow.
So he actually left.
It seems like Simons was willing to make these like tough decisions to protect the integrity of his approach, even if it meant like losing a brilliant mind like Axe.
It shows how much conviction he had
Yeah, definitely.
in his data-driven approach.
And it paid off, right? I think the Rio Claro Investimentos video mentions how the fund's returns like just skyrocketed in the early 90s. Like in 1990, they hit a 77.8% return.
Wow.
That's insane.
So that's when the legend of Medallion really started to take shape.
Totally.
But even with all this early success, they knew they needed more advanced technology, right, to really scale their operations and tackle the complexities of the stock market.
And that's where Peter Brown and Robert Mercer come in, right?
Right?
Those two brilliant computer scientists from IBM, they'd been working on these early artificial intelligence projects, and they were specifically brought in to like help overcome those challenges of applying their models to the stock market.
So they were essentially building that technological foundation that would allow Renaissance to like reach its full potential.
Exactly. Brown and Mercer were like instrumental in building the infrastructure and the algorithms that let Renaissance scale up their operations and like really handle the complexity of the stock market. They created the technological backbone that made Simon's vision a reality.
Yeah, the videos describe how their trading system just like exploded, right? I mean,
Yeah.
it grew to over 500,000 lines of code. It was processing huge amounts of data and executing trades automatically. Back then, that was like unheard of.
Oh, yeah. It was the dawn of algorithmic trading. Computers making trading decisions based on these pre-programmed rules and complex math models. Renaissance was a pioneer in this field, and their success helped pave the way for the algorithmic trading that we see, you know, everywhere today.
But it wasn't all smooth sailing, though, right? There was that famous story about the bug in their stock trading system.
Oh, right, right.
That went undetected for months and ended up costing them millions.
It's crazy how, like, one tiny error can have such huge consequences, right?
Yeah.
It really shows, even with the most advanced systems, you can't forget about testing and vigilance.
And the thing is, that bug was directly related to them trying to, like, crack the code of the stock market, which turned out to be way harder than commodities or currencies.
Right.
So they were, like, really pushing the boundaries of what was possible with quantitative trading. And of course, they ran into some obstacles, but they were determined to figure it out. They wanted to conquer the stock market.
And that's exactly what they did.
Yeah.
I mean, by the late 90s, the Medallion Fund was generating these, like, phenomenal returns, attracting billions in investments. Their employees were getting incredibly wealthy.
But all that success comes with its own set of challenges, right?
Yeah.
I mean, their profile just, like, blew up.
Yeah.
And with all that attention, things got, well, complicated.
Yeah, that's right. I guess we'll have to talk about that more in the next part of our deep dive, like how Renaissance Technologies managed their growth, all the steps they took to protect their intellectual property, and like all the ethical questions that started to emerge as their influence grew. So we left off talking about how Renaissance Technologies was like really starting to make waves in the financial world. But to understand their success, we need to like dig a little deeper into their trading strategies, right?
Yeah, I'm curious about that. Early on, you mentioned they were using these trend-following models.
Right. But as their team grew and technology advanced, their approach became like way more sophisticated.
So for those of us who aren't like Wall Street whizzes, can you break down what a trend-following model actually is? It sounds kind of simple when you say it like that.
Yeah, it's like conceptually pretty straightforward. Imagine you have like a simple moving average. It's basically a line that represents like the average price of a stock or whatever over a certain period of time. And like a trend following model might buy when the price crosses above that moving average, right?
Right.
Because it's signaling that there's an upward trend. And then it would sell when it crosses below, indicating a downward trend.
So they were trying to like ride the waves of market momentum.
Yeah, basically.
Oh.
But they were doing it in a very systematic, data-driven way. But as they started, moving into the stock market, they realized that simple trend following wasn't going to cut it. Like the stock market is way more complex, way less predictable than, say, currencies or commodities.
Gotcha. So they needed a more nuanced approach.
Exactly. And this is where their understanding of like statistical arbitrage really comes into play. This is a strategy where you try to identify these like temporary pricing discrepancies between like related securities, and then you try to profit from those tiny little differences.
Okay, so like I don't know, if Pepsi stock goes up but Coke's price doesn't move, their model might see that as like a temporary thing, right?
Yeah.
And automatically buy Coke and short sell Pepsi, expecting those prices to like even out eventually.
Yeah, that's a simplified example, but you got the basic idea. Of course, Renaissance's models were like way more complex, right? They incorporated tons of data and identified correlations that, most human traders would just miss.
And this is where the whole machine learning thing comes in, right?
Right.
Like their systems weren't just following like some pre-programmed rules. They were actually like constantly learning and adapting and refining their models based on all this new data.
Exactly. And that ability to adapt, it's crucial in the financial markets because they're constantly evolving.
Right.
But even with their advanced models, Renaissance Technologies hit a bit of a wall. This one video that Tenciencia won, it highlights how they struggled to replicate their early success when they first started trading stocks.
That's kind of surprising. I mean, you think a firm that's so good at finding patterns and exploiting market inefficiencies, you'd think they'd crush it in the stock market, right?
You'd think so. But the stock market, it's notoriously difficult to predict. Even with sophisticated algorithms. I mean, it's influenced by so many things, right? Macroeconomic trends, company earnings, news events. I mean, even like social media sentiment. It's a much noisier environment.
So their models were basically getting overwhelmed by all the data.
Yeah, in a sense. But remember that story about the bug in their stock trading system?
The one that cost them millions. Oh,
Yeah, it really shows you that even the smartest people and the most advanced technology, they can still make mistakes.
absolutely.
But here's the thing. Fixing that bug, it wasn't just about preventing more errors. According to this Chico Coelho video, I think, it was actually like a major turning point.
So fixing that bug actually helped them improve their stock trading models.
Yeah, it's kind of wild. What they found was that the bug was causing their models to misinterpret certain market signals. And that was leading to inaccurate predictions and obviously, losses.
So by fixing the bug, they were basically like removing this blind spot.
Exactly. And once they did that, their models started to see the stock market in a whole new light.
That's amazing.
The Rio Claro Investimentos video mentions that their stock trading performance, it got so much better after they fixed that bug. And in 2000, they had this insane 128% return.
Wow, what a turnaround. So they basically turned a mistake into this huge leap forward.
Yeah, and it shows you one of the core principles at Renaissance Technologies, this commitment to constant improvement and learning from their mistakes.
Yeah, it's a good reminder for all of us, really. Even the most successful people, organizations, they make mistakes, but it's how you respond that really matters.
Exactly. And in this case, their response led them to cracking the code of the stock market. I mean, they achieved this level of success that no one else has been able to replicate.
It's pretty remarkable. But all that success must have brought new challenges, right? I mean, the more they succeeded, the more attention they got.
Oh, for sure.
Yeah.
And that's what we're going to talk about in the next part of our deep dive, how Renaissance Technologies handled all that phenomenal growth, how they protected their intellectual property, and all the ethical considerations that came up as they became more and more influential.
So last time we were talking about how Renaissance Technologies had this incredible success. But obviously that level of success, it comes with its own unique challenges, right? And the Quant Investmentos video point out something really interesting about their fees. Those insane returns didn't come cheap. They were charging a 5% management fee and a 44% performance fee, which is unheard of in the hedge fund world.
Yeah, that's definitely not your typical fee structure. I mean, most hedge funds, they use the 2 and 20 model, right? 2% management fee, 20% performance fee.
So why were they able to charge so much more? Were investors just so desperate to get in on those returns that they were willing to pay anything?
Well, I think it's probably a few things. First, their track record, it was phenomenal. So, of course, investors were going to be interested. But the high fees, I think they also served another purpose. They acted as kind of a barrier to entry.
Ah, okay. So it wasn't just about making as much money as possible.
Right. It was also about controlling the fund's growth.
Yeah.
Making sure their strategies wouldn't get diluted by having too much money to manage.
So they understood that their advantage was in exploiting these subtle market inefficiencies, and those inefficiencies would probably disappear if they were managing a ton of money.
Exactly. I mean, if you have too much capital, you start moving the market yourself, and that can mess up your whole strategy.
Right, right. So the high fees were actually a way to maintain their edge and keep their secret sauce, secret.
Yeah, I think that's a good way to put it. And you have to remember all this exclusivity. I mean, it just added to the mystery surrounding Renaissance Technologies.
And then they decided to completely closed the Medallion Fund to outside investors.
Right, back in the early 2000s.
So even after Simons retired, back in 2010, and Peter Brown and Robert Mercer took over, they kept that policy in place.
Yeah. By only letting employees invest, they could keep a much tighter lid on their intellectual property.
Mm-hmm.
And that minimized the risk of someone, reverse engineering their strategies. It was this super exclusive club.
Yeah, it sounds like a pretty sweet deal if you were one of those employees.
For sure.
But the videos also talked about how, this whole culture wasn't without its issues, right?
Right.
Specifically, Mercer's involvement in politics, his support for Donald Trump, it caused some controversy, even some internal conflict within the firm.
Yeah, that definitely created some tension. It kind of raises the question, right? Where's the line between your personal beliefs and your business decisions? Especially for a firm like Renaissance Technologies. I mean, they were incredibly influential.
Right. And it just goes to show that even in a place that's supposedly all about, data and objectivity, human factors, they still matter.
Oh, absolutely. It's a complex situation, and there's no, easy answer.
Well, I think this deep dive has been incredibly eye-opening. We've learned about how Jim Simons and Renaissance Technologies kind of changed the game when it comes to investing, how they used math and data and technology in this totally new way. But their story also brings up these really important questions, about the role of technology in finance, the potential for market manipulation, and all the ethical stuff that comes up as these quantitative strategies become more common.
Yeah, it makes you think about where finance is headed, right?
Right.
I mean, will we see more firms like Renaissance Technologies, or was their success like a one-time thing? It's hard
Yeah.
to say.
I guess time will tell. But their story is, I don't know, it's inspiring in a way. It shows what's possible with data-driven decision-making. But it also shows how complex and challenging it can be, to handle that kind of success.
Yeah, for sure. It's been a fascinating journey learning about them.
Definitely. And for all of you listening, if you're interested in this whole world of quantitative investing, I definitely encourage you to check out the resources we talked about. Do some more digging on your own. There's always more to learn, more to question, and who knows what else is out there waiting to be discovered.